And so we could actually make this a profitable tool that everybody wins on, right? But the purpose was for the client, for the insured. The accountants got a hold of it somewhere in the 80s because they made decisions out of fear. And what happens when we make a decision out of fear?
Right. It's not good.
It's almost always the wrong decision, right? Scarcity, it just kills it. And they made a decision to come up with a product that was good for the company, but not necessarily good for the consumer. And that's where they lost their purpose. And now they have a terrible reputation, the insurance companies, that they've earned legitimately.
Today I have the pleasure of interviewing one of my mentors. We were just talking how I went to 11 software schools that he taught within 3 years. I think it was within 2 years, honestly. I was like, I'm going to learn this inside and out. And you have this really unique ability to know software and teach.
Well,
that's like the unique combination.
Well, it's one of those things of being able to get away from the numbers, and it's always a tough thing. I think when you get hung up in the numbers, it's hard to relate that to people, because people don't think in terms of numbers. But it's something that we had to do, and we had to prove they were right. It was interesting, something that I talked to Spencer about recently. I said, the numbers are vital, and the numbers don't matter. And somehow that's not contradictory. Well, it's not, because as long as the numbers are right, then it doesn't matter what they are. People don't care about that side of it. But what we saw in you early on was, man, Garrett's a new guy. You were right out of school. You decided you wanted this to be, you wanted this to be your career, and you did the work. You showed up. You paid attention. You learned. You asked. You pushed, and that's where knowledge and drive comes from, I think.
Yeah, I think that a lot of people think I have a lot more regular viewing of numbers and know numbers inside and out, but the reality is I know the philosophy and the concepts.
Right, because
and the numbers support that, but it's like I don't have to dive into that every day anymore. So one of the reasons I wanted to interview you is there's this epidemic of people buying index universal life, and it's just being sold with only part of the story, and people have no idea there's risk in it or risk to it, and it's just happening in the masses. And so index universal life is like, I'll let you describe it a little bit.
Well, it's interesting, and it goes to what you were saying, and what it's sold as primarily is you get to take advantage of the upside of the market, and you don't participate in the downturns, which is totally not true, because there's so many aspects of risk that are outside of that. Sure, they protect one side of it, but the problem is it's built on the UL chassis. And, if you look at where universal life is, people say, oh, the universal life is whole life for half the price. It can't be half the price.
Yeah, why would it?
Yeah. Everything. And something we were talking about Norman Baker earlier, and the thing about, one of the things that Norman taught me early on was there are no deals in the insurance industry. And that is a classic thing. And if you put everything in that perspective, you can see what's going on. And what he meant was everything is a trade-off between cost and risk for the insurance company. So if something costs less, i.e. term insurance on the extreme low side, it's because there's very little risk to the insurance company, right? It's not going to pay off.
They're in the business of making a profit.
Right. On the upside, why is whole life insurance? Why are the premiums higher on whole life? Because the insurance company is on the hook to make that come out. It's because of the guarantees that sit on that. So universal life is somewhere between the two. What does that mean? What that means is there's less risk for the insurance company, and it's why they can charge a lower price for it. But yet it's sold as the same thing as whole life insurance. In fact, part of it is in the name. It's classified as permanent insurance.
Right.
Now, what does that mean? What does permanent mean to you?
That it'll be around one day longer than me.
Right.
For sure.
Permanent has to be there, right? It has to be there. That's what permanent is. And yet universal life doesn't fit that. All it is extended term insurance, really.
Right. It's built upon this term insurance chassis.
Right.
Right. Which is annually renewable, and it can go up every year as you get older.
Right. And, not to get too deep into the woods, but just thinking about an analogy with term insurance for a minute. And in the old days, term insurance was all that was available was it was called YRT, or yearly renewable term insurance, and the term insurance premiums went up each year as you got older because your risk of death was higher, right?
Right.
And the older you got, the steeper the curve was, so the increase started happening faster and faster.
And it priced you out.
Right. The insurance companies came in, and they came up with this idea of, hey, we have a newer, cheaper term insurance, and it was level term insurance, and it was bizarre. It's like, okay, this term insurance came in, and then the premium starts lower than the first YRT premium, and it stays down there for 30 years. How in the world can they do that?
The 31st year.
Because the 31st year, the premium has to get it back on the mortality curve. So you might go from a $2,000 annual premium to 60 or 70,000 in the next year. And people look at it as, oh, that's the insurance company trying to drive you off the risk. No, what it really was catching up to the actual mortality curve, because they had undercharged on the front. And now they have to throw the charges way up because of where that mortality risk curve is, right? So part of that is what they've done in some of the way UL policies are structured that same way. They undercharge on the front end with the necessity to have some lapses along the way. When that doesn't happen, and you've seen it with clients that come to you, and the unfortunate thing, man, you talk about people sad. They put away money forever, and now all of a sudden they find out this thing is about to fall apart. It's not going to last. And part of the reason for that is if they undercharged for those mortality charges early in the policy, and they have to catch them up on the back, not only is there less money there, but the amount they have to pull out to stay on that curve just destroys it. It just eats the policy, and there's no way to keep it alive.
Right, and things that could compound that would be more people dying than anticipated when they first bought the policy, right?
Right.
Or the performance not being as good as projected because they're charging the cost of insurance based upon cash value versus death benefit.
Right.
So the more cash you have in your illustration, the more that cost is hidden, because that's diminishing some of that cost. But if it doesn't perform, you're going to have higher costs of insurance in the future. And if more people are dying, which what I learned early on in my career was, because they looked so good when I first saw them.
Sure.
And I was like, what's the catch? And then the catch was, well, if you're in good health, you'll eventually just jump ship to another policy, because these policies get antiquated pretty quickly and the new ones have better bells and whistles. So everybody jumps and ship other than the people who aren't healthy. And now all of a sudden, the higher cost of insurance starts getting jacked up because all the unhealthy people are staying in that bundle.
Sure, you've killed the risk, basically. I mean, you've killed the pool, right?
And most of these insurance agents haven't even been around long enough to see that occur. So they're selling into a future that they don't even understand how it's going to impact.
No. And if you've ever seen what happens to families when they come to you and say, my husband or my wife put money into this. We did without vacations. We did all these things all these times. Now that spouse has died, I find out the life insurance doesn't exist. And you know what they say from that? They say insurance companies don't pay claims.
Yeah.
No, that's not what happened.
Yeah.
That's not what happened. What happened was they bought a faulty product because it was sold to them as something that was permanent, and it turns out not to be when they actually look at it and need it.
So one of the things I've heard people say is, well, people are living longer now, so that's going to make the insurance costs better.
No.
But the reality is, U.S. in the last 2 years, we've actually gone down on that living curve.
We have. And I think there's a reason behind it. I really, this is outside of what we're talking about, but I think it has to do with, if you look at society, we have a group of affluent people that look to health as an important thing, and they are more healthy and living longer. But you also have the other group that has said, I don't care if somebody's going to take care of me. I'm just going to sit in the lazy boy and watch television. Okay, so they're weighting down the average so heavily. Yes, the overall mortality curve actually went down slightly. The longevity went down in the last couple of years. But in reality, I think of the affluent people, I don't think that's true.
It actually improved.
Right.
Right, because because we've seen enhanced dividend policies where if it's a bigger policy, they actually give you better benefits because you're more likely to have longevity.
Right. And I was kind of discussing something recently with my wife, Kim Butler, about the idea of, universal life is really a zero-sum game. And that's not what we're about. That's not what you're about. It's all about, when we're looking at purpose about and profit, that needs to be for all parties. It needs to be win, win, win. But
right.
And that's where the insurance company started out. That's what the whole purpose of what they were doing in the whole life side was. It was the idea of creating a pool of money so that a spouse wasn't devastated at the loss of a spouse, that they could survive because it was a problem at one time. And that was the primary focus. That was the purpose of the insurance company. And then they started figuring out, hey, look, we could make a profit, divide that in dividends, and so we could actually make this a profitable tool that everybody wins on, right? But the purpose was for the client, for the insured. The accountants got a hold of it somewhere in the 80s because they made decisions out of fear. And what happens when we make a decision out of fear?
Right. It's not good.
It's almost always the wrong
Yeah.
decision, right? Scarcity, it just kills it. And they made a decision to come up with a product that was good for the company, but not necessarily good for the consumer. And that's where they lost their purpose. And now they have a terrible reputation, the insurance companies, that they've earned legitimately, right?
Right. The predecessor to Index Universal Life, Variable Universal Life. I remember going to Scotland. I'm on a bus with two insurance company presidents, and they were talking about the impending amount of lawsuits they were going to face with the 2008 recession that was happening because of how devastated these policies were. And they were talking about the double dip. You're losing value inside of your cash value, which is increasing your cost of insurance at a time where your shares have less. And they were, and I went to this meeting where it was all these insurance producers, and they were arguing and fighting and asking if they could convert it to an index universal life, right? So they're like, can we take worse to a little bit better?
Right.
And where there's a lot of complexity in index universal life that people don't really understand, like how the cash value is credited, how the index works. One question I don't know the answer to that I'm guessing you will know the answer to is, let's say I have an index universal life policy and I don't want to pay taxes, so I'm borrowing the cash, right? So I'm using my cash value as collateral. The insurance company is giving me their cash. Does that change my cost of insurance?
You know, I don't know on that side.
And what does that do to the net amount at risk?
I know several people that have asked this question. What happens if there's a loan out and the index goes down because they can't model it? It's like nobody has the model for that. We don't really know what's going to happen.
Right.
So wait a second. What does the term insurance mean? Insure to make happen? And now then we have unknowns in something that's supposed to make sure something happens. I mean, to me, it's kind of contradictory.
Yes, I'm concerned about that. And then the crediting has a lot of complexity.
Absolutely.
How much they get to participate in or not participate in, or
and
when
sequencing.
It credits, that's
a big issue too. The sequencing of returns, just what you were talking about, when that crediting occurs. Okay,
Yeah.
so when they got into the policy, and then when they measure what the index does across that time. So every one of those is different depending on when the start date was, when the anniversary date was, is when the credit happens. And yet what we're seeing on illustrations, they're going to look back 40 years, 30 years on some companies, but most of the big ones are looking back 40 years. They're able to take the average return for the last 40 years, average, not actual, and look into the future and say, hey, let's see what this policy does if it does this for the next forever, right? At that rate, with no downs and no ups. And what we know in the marketplace, when the downs
and ups, yeah.
right, and the downs always hurt more than the ups help, right? And so now we've got a situation where we've got a level amount. We're looking out there into the future. And the unfortunate thing is we see whole life policies, solid whole life policies that have been on the books, that are seasoned and performing, and those are getting replaced for something that might happen.
Right, and there's just so many levers because the insurance company can change the cost of insurance. It's right there in the contract, and they even show the guaranteed column, which always ends up being zero.
Right.
With guaranteed costs, it actually kills
Quickly.
the policy, right? And yet people don't look at that because like, oh, well, that's not going to happen. Well, I get it might not happen this year, but what about 10 years or 20 years? Like any provision that's in there, count on it eventually being used. They're not putting it in there to be like, no, we don't ever plan on doing this. No, you put it in there because you have a concern.
It's not to protect the consumer, it's to protect the insurance company, right?
So we've got that factor. So cost of insurance can be, change over time. We already know that the index is changing over time. And then could they only show 6.81? Is that the max they can show, but it's level?
The max, they have adjusted where those top ends are, but again, it assumes that it stays and doesn't change as time goes on, that there's, you don't see the impacts of what happens.
6.81 is completely different than an actual return that was level because it's like a staircase versus you're falling down and you're climbing back up.
Exactly, especially when you have caps in there on what the upside is. So that really kills your average if you think about it, because now then, let's say that it's set at negative. And yes, the argument is, hey, with my particular policy, and different policies are structured different ways. Some of them have, a zero floor, some of them are 2% floor, whatever it is. But they have a floor on the bottom end. But in order to be able to do that, they have to cap the top end. So let's say the market rebounds and has a 20% 10% rebound, but your cap's at 8. Okay, now then you had the downside at 0, but you don't get the upside on the other end. I've actually done some analysis looking at the last 4 years or 40 years of the S&P. If you eliminated the floor, so in other words, let it go below the minimum guarantees and eliminated the cap, they would actually come out better. That what is sold as a safety net
blanket, yeah,
actually hurts the actual overall return.
I think the biggest thing to take from this is like there's a lot of moving pieces. There's a lot of things that you're not being told. There's a lot of things you don't understand, and you're going to go put your future in this level of uncertainty.
Right. Again, we're back to undermining the word insurance. It's people think because they hear insurer, they think because they hear permanent that's what they're buying.
Like some people are even just saying, "Oh, well, the insurance just for the tax shelter." This is I mean, I've just heard a lot.
Yeah, but what'll happen is eventually they're going to get amnesia, and they're going to think that the reason they bought it or that you sold that to them was a completely different product. Let me ask you this. So
I got in a fight in a phone call with this one gentleman about this.
And I understand that because we're rooted in what we believe. And if somebody has sold it, think about this. It's hard for them to look outside and realize, man, even they may have done it on accident. They may not have known any better.
These people, in his whole thing to me was, I don't think you understand Index Universal Life, and it's just easier to sell because it's simpler. I was like, actually, I can't think of anything more complicated in the insurance industry than Indexed UL.
Unless you don't explain it.
VUL's easier.
Right.
UL's easier.
Right. But what if you don't explain it? And then you just sell it, and you sell it by, hey, look how much better this is.
They're just buying a different version of an indexed annuity.
Right.
That's really what they're being sold.
If somebody came to you and said, look, here's some insurance. Look at this great illustration that I have that's, a gazillion dollars out there at the end. But there's a likelihood that this thing might be 0. Would you do that? Instead of something that's guaranteed to happen.
Right, but all they look at is the bigger number on the piece of paper as if it's 2 equal ways to get there.
Right.
2 equal methodologies is not. One number is bigger on a piece of paper. It doesn't mean it's actually going to happen, which goes back to your first part of this conversation. Like, the numbers don't matter if they're based upon a faulty platform.
Right. It's all on the outside of that. What are the other risks? What are the other levers, as you mentioned, from the outside that are going to determine whether or not any of it happens?
Yeah.
So, this is great if it comes out like this. I saw one not too long ago. So here was the difference between the guarantees and the projected. They had money going in for a short period of time, and then they had money coming out, and what they depend on is an arbitrage.
Yep.
Okay, so wait a second. The arbitrage, we'll get to that in a minute, but so
part of that is default, right? Policy default.
Right, but how can the insurance company credit more than they're taking in on the other side? How can the insurance company survive in an arbitrage? They illustrate it, but in reality, I can't figure out how that can actually happen and the company be profitable, right? So the difference was, there was money going in, a huge amount of money coming out. The guarantees showed the policy dying in like the 3rd year of withdrawals. The illustrated showed the policy going for 30 years with those withdrawals and having $5 million left over at the end. Now, that is a wide spread between what the insurance company is willing to guarantee and what they're illustrating. And to me, think about this. Would the insurance company be more profitable by selling more policies? Yeah, that's what they want to do, right? They want to sell. Okay, so any marketing they can do towards enticing people to buy a policy would be beneficial, right? So my point in this is they're going to want to put their guarantees as high as possible in order to entice people to come in there. And yet, look at what the insurance company is willing to guarantee. To me, that is a sign of what they really believe that thing can do.
All right. Well, this is all the food for thought, and that people can now think about that they're not just getting a easy, perfect, it's all going to work out. There's a lot of holes in this road. There's a lot of, downsides, and hopefully we help people think and ask better questions.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.